Good day and welcome to this new video where we will talk about pension investing for ETFs, exchange traded funds. Now, ETF, exchange traded fund, is somewhat of a magic word when it comes to pension investing, especially for beginner investors. Certainly, when it comes to securing your pension, I think you should always primarily invest in ETFs, exchange traded funds, unless you have an advanced background in, for example, analyzing stocks or analyzing bonds, as we have seen. But if you don't have that, and I think that applies to about 95% of all of us, then we might as well stick with ETFs, exchange-traded funds. Now, why and what does it entail? We will explain that in this video, but ETFs, exchange-traded funds, are not the magic word for guaranteed success, as there are also risks involved. But first, let's take a look at what an ETF, exchange-traded fund, is, what it entails, and why an ETF is not without risk. So, don't be mistaken. Investors face risks, even if you choose to take on less risk. Finally, we will look at which ETFs, exchange-traded funds, are suitable for a pension, purely in terms of their characteristics. A few examples will be provided so you can get a better feel for what is involved, what to look for, and important features. A few examples, I will also take a look at it via Giro, a Dutch online brokerage platform, which gives a better feel for it. And lastly, and this is very important, how can you invest in ETFs, exchange-traded funds? It's not as simple as just buying and selling, because in principle anyone can do that. But this is about timing and how to handle it. Especially because it is indeed long-term, we should not underestimate that, as we often refer to emotional discipline. That is why it is the happy investor's mindset. It is about the way of thinking. However, not everyone has emotional discipline, especially not when things are going poorly. So, what is an ETF? An ETF stands for an exchange-traded fund. We can dwell on it for a long time, but that isn't really necessary. It's simply an exchange-traded stock fund or bond fund. There are different types. It is sometimes referred to as a basket of golden eggs, but that is a bit of an exaggeration, and I will explain why. Essentially, it's simple. You have a basket, and it contains different types of assets. An asset can be a stock, a bond can be an asset, even crypto can be an asset. Nowadays, there are also crypto ETFs, exchange-traded funds, but of course those are not suitable for pension investing. Why is it so relevant? Because the ETF, exchange-traded fund, was designed as a passive investment product. This goes back a bit to the theory of investing, which actually concerns the playing field between active versus passive management. Suppose you start now and simply buy 20 very good stocks. Each gives you 5%, so 100% in total. And all he does is buy and hold for 10 years. Then there is a real chance that after 10 years, you will have an even higher return than if you actively buy and sell every year. Of course, there are many people who are against this, and with happy value stocks or happy growth stocks, we also focus a bit more on the short term. We always try to select stocks that are good to hold for the long term, but that can achieve higher returns in the short term, because it goes with peaks and valleys, and it is influenced by momentum. This is not for this course, but at least know that there are many dimensions to valuing a stock or bond, and determining whether it is a good purchase. With an ETF, exchange-traded fund, you don't have to worry about that at all. Essentially, an ETF tracks the underlying values of multiple stocks or bonds. An ETF is also referred to as a tracker. You know, just like your Fitbit, that's a tracker. It measures your wrist, your heart rate. An ETF, exchange-traded fund, what it actually does is measure the underlying values of many different stocks or bonds. There can be one, but that is not a good ETF. Exchange-traded fund. I will explain more concretely why shortly. However, what is particularly interesting, especially for pension investors, is that you have equity funds that follow 500, 1,000, or even 10,000 or even 16,000 different stocks or bonds. So concretely, if you open your Giro, a Dutch online brokerage platform, and buy one ETF, exchange-traded fund, that contains 5,000 stocks spread all over the world, then you have a portfolio with 5,000 stocks all at once, and it's just that simple. The management simply follows all those stocks. It does not consciously buy and sell to achieve potential returns. Of course, it has to buy and sell because they have constantly changing liquidity. There are people who purchase it, and there are people who sell the ETF, exchange-traded fund. So, there are indeed fluctuations in money. But it's not that the fund is trying to, okay, wait a minute, this stock is going to rise by 50% in the next 3 months. I'll take some profits and invest that in another stock. that might also rise in the short term, with the risk of misjudging and incurring losses. With the ETF, Exchange Traded Fund, we all don't have to worry. And what I find amusing is a funny picture. The difference between a stock and an ETF, Exchange Traded Fund, and why this image? Because the image is actually incorrect. What can be expected? A stock generally goes up and down erratically. This is referred to as volatility. Price volatility. The higher the volatility, the more severe the peaks and troughs are in the short term. An ETF, Exchange Traded Fund, essentially has much fewer of these kinds of severe peaks and troughs. But it really doesn't just go up gradually and steadily like a hockey stick. In fact, an ETF, Exchange Traded Fund, can also experience serious declines, and you can simply think of a drop of 50% as something that has occurred frequently and will occur much more often. That means you think, oh yes, I'm comfortably earning interest. I have a lot of money in, let's say, an ETF, Exchange Traded Fund, of 10,000 different stocks, and I'm safe. That's not true, and I will demonstrate why shortly. But that share, so that ETF, Exchange Traded Fund, can in principle just drop by a significant percentage. And that is why a separate investment strategy is needed. We will address this under point 5. There are ways to employ the right strategy even with ETFs, Exchange Traded Funds, to achieve higher returns, and thus also to reduce your risk. And just by having a bit of knowledge and content and experiences, you can apply all of that. There are different types of ETFs, Exchange Traded Funds. The most well-known are the stock ETFs, so the equity ETFs. That is, a fund that tracks, for example, 1,000 different stocks. In such a fund with those 1,000 stocks, it is not the case that those 1,000 stocks are the same every year. There is a term that indicates how much a stock or a fund changes each year in percentage. This is called the turnover rate. We will also cover the turnover rate in our ETF, Exchange Traded Fund course, where we will analyze ETFs. In it, you can see what the percentage is of how much a fund exchanges with stocks. In principle, the lower that turnover rate is, the more it is a characteristic that it is relatively more stable, or let's say, somewhat more predictable in the future. Because, yes, the stocks they have now, in X years, they will probably still have 90% of those stocks, and that is with the stocks. But of course, there are also other types of ETFs, Exchange Traded Funds, namely bond ETFs, which are particularly suitable for those who are already retired or approaching retirement. There are commodity ETFs, Exchange Traded Funds. So commodity ETFs. And why is this interesting? Because with ETFs, you buy a bundle of those commodity ETFs. Think of a bundle of gold mining companies, combined with silver mining companies, a bit of cobalt, lithium, and possibly also natural gases and oil. Then, of course, you buy a whole bundle of what are essentially risky and cyclically bound stocks. They can experience significant peaks and troughs, but they can also rise dramatically. So, when you buy an ETF, Exchange Traded Fund, you can purchase one that has the potential to achieve a high return over the medium term of 1 to 3 years. You also have sector or industry ETFs, which are also referred to as thematic ETFs. There are various currency ETFs. There are leveraged ETFs, which essentially means you buy a certain amount. For example, an Alphabet or an Amazon, only then times 2. And this naturally tends towards speculation and gambling. So I invest €1 in this stock, and if it increases by 1%, it actually increases by 2%, or in other words, it doubles. But suppose I buy this stock and it drops by 50%, then it drops by 2 times, so 100%, and I lose all my money. And the higher that leverage is, the more risky it becomes. What is the name of that company? Something with 500. In any case, you have a few well-known brokers in the Netherlands. And then you can invest with leverage. That is super risky. Something you always want to avoid, not just for retirement, but at all times. So it makes no sense. You don't have to take risks. You just need to invest wisely. Well, and then you have inverse ETFs. Actually, that one, yes, inverse says it all, right? So that ETF bets that the stock will decline. And suppose your stock drops by 50%, then your ETF rises by 100%. When you invest in an ETF, it's important to understand how changes in the stock market can impact your investment. For instance, if the stock price increases by 50%, the value of your shares in that ETF will be inversely affected. This means that instead of benefiting directly from the rise, your investment might not perform as well as you hoped. The reason for this is that ETFs are designed to track the performance of a specific index or sector, and they may not always align perfectly with individual stock movements. Therefore, while you might expect to see a significant gain, the actual outcome could be different, and you might not achieve the better results you were aiming for. It's crucial to consider these factors when evaluating your investment strategy and to understand that the performance of ETFs can vary based on market conditions and the specific stocks they include. You're not trying to do poorly either. You just want to achieve average returns. And for 95% of us, as beginner investors, that is simply the best strategy. By far, the only thing you need. This image also shows it. The magic recipe is indeed simply consistency plus a lot of patience. And in the long term, as the economy rises, as the world population continues to grow, and as prosperity increases, and the companies in our fund all rise, we will have an average return in the long term. That is what an ETF is. And particularly, the aspect of consistency and patience is therefore very important. Now, there is another difference between ETFs and what they call mutual funds. And in principle, you can see it as a type of investment fund. It can be both non-listed and listed. And the difference is actually that, well, let's say there is a similarity between the two. The ETF follows, for example, 1,000 stocks, and so do mutual funds. They both track multiple stocks or multiple bonds. In a mutual fund, you can also have stocks, bonds, and commodities. This is less common in an ETF. A mutual fund is usually not traded or listed on an exchange, so it is not exchange traded. An important aspect is the difference in costs. ETFs are generally cheaper. This is a statistical measurement. The source reference is provided below. ETFs cost an average of 0.20% per year, while mutual funds cost an average of 0.8% per year. Why? Because mutual funds are considered active types. This means that the management actively seeks out the potentially best performing stocks or bonds of commodities or real estate stocks and actively trades in them. So, actively working based on a strategy, and because they are managing their assets, you have higher personnel costs, resulting in a higher cost item. Therefore, they charge higher fees. Now, why do you think I would invest in such a mutual fund? Because that fund naturally tries to achieve a higher return than the average. So theoretically, if you have an ETF with 1,000 stocks and a mutual fund that exactly follows those same 1,000 stocks, then they would select the best stocks within those 1,000. Through good allocation and by timing their sales correctly, thereby achieving a higher return than ETFs. But in the long term, based on research, which is proven and statistically significant, we see that an ETF usually performs better. This is quite remarkable. And they perform even better because their costs are much lower. So yes, there are mutual funds that perform much better, especially in the short term. So think of a time perspective of 5 years where they perform significantly better, but over the longer term, say 10 or 20 years, it often falls quite short. And then you also have to know which funds those are. So yes, a combination of the two is always useful. But you can also simply choose to invest passively with a good selection of ETFs. Hey, it's great you're visiting our website www.businessinvested.info. There you can find track record of money investments and our performance. And then go to free investing tools where you can download a whole bunch of free investment tools. For example, stock portfolio tools, stock calculators for intrinsic valuation, and also free investment ebooks, ETF investing guide, stock investing guide, and more are coming soon. An ETF is certainly not without risk. And that is, of course, very relevant when we talk about retirement investing or as you approach your retirement. Because the closer you are to retirement, or if you are already retired, you actually want to invest in assets that carry less risk. ETFs are by definition lower risk, but we must realize that they are not without risk. That is a very important point. Let's take a step back to discuss risk diversification. Not all ETFs offer the same level of risk diversification. Therefore, it is very important that if you want to reduce volatility, which refers to price fluctuations, you need to focus on risk diversification. To achieve lower volatility, you should look at ETFs in low-risk assets that are well diversified. So think of having a lot of positions, so a lot of different bonds, for example, 1,000 different bonds. That is a different difference than 100 bonds. And it is also such a big difference if those German bonds are spread across America, Europe, Asia, and other countries, because then it also provides a lot of geographical diversification. In geography, geographical diversification is also important in your investment strategy to reduce price volatility. Now, the most relevant risk when it comes to retirement investing is that volatility, and actually not wanting to have any unexpected price drops. Unfortunately, there is bad news because there is indeed market risk. Market risk is actually the systematic risk. This means that when you invest in a particular stock market, there is always the systematic risk that such a stock market will rise or fall. And of course, that is the essence. That's why you want to invest in markets, because you expect it to rise in the long term. But in the short term, think of 1 to 3 years. It could also be 6 months, or even a month. An ETF can also drop seriously hard. Simply put, one small example is the AEX, which includes 25 different companies, namely the largest publicly traded companies in the Netherlands. Now, 25 is not a lot, and it's all in the Netherlands. So yes, when you talk about retirement investing, I think it's nice that you're Dutch, but look, beyond your own nose, Ajax is just a tiny little player on the big stage. And certainly, if you think in the Dutch industry I have confidence in, it's your money, do with it what you want, but you understand about diversification, then you actually want to buy ETFs that invest in both American stocks, as well as German, Dutch, and even Greek stocks, but also those in Asia, New Zealand, I don't know what, so the whole world. Then you realize true diversification across the world. That does not mean that they do not have risks in the short term. We will look at some examples of that shortly. But we see here, for example, with the fund of the AEX, even though there are 25 different Dutch companies from various industries, you still see that in the short term. In this case, the price was around 700 in the year 2000, and here it drops to around 200 in 3 years. So, indeed, a third of your wealth remains. So you think, I'm doing well with my pension, I put 10,000 euros of my money in, and here you have only about, what will it be, 3,000 euros. And you can see that pattern, it repeats itself every so often. This is also called market cycles. You have high and low cycles, which are economic terms. But to keep it simple, the market goes through peaks and valleys. Even if you buy a lot of different stocks, like an ETF, then you still have those peaks and valleys, only it just happens a bit slower. That's also why I said that the other picture was incorrect. An ETF does not come without risk. An ETF does not rise very slowly and smoothly like that. Coincidentally, it has been slowly rising nicely here lately since the financial crisis. But you see, in the meantime, there have still been a few significant dips. Don't be mistaken, we are talking about declines of 15 to 20%. This large peak here was during the COVID crisis, which was minus 30%. Yes, that is really quite disappointing if you invest over a period of 3 to 5 years, because you might find yourself right at the beginning of such a huge event, and you don't want that. So, in point 5, I will talk more about that, how you can deal with it and how you can anticipate it. Now, another very important risk, which again relates to diversification, is that thematic ETFs can fall out of favor. In other words, it can lead to permanent loss. What is a thematic ETF? I have previously shown a picture of the different types of ETFs, and then you had one type of ETF, namely industry or sector. A thematic ETF is essentially a fund that focuses on a single industry or sector. And here we simply have one example just purely for illustration, the iShares Global Clean Energy ETF. It is an ETF, so that means it contains multiple stocks. You just need to look up the fund to determine how many shares it contains. In this case, the theme is clean energy, and global refers to a worldwide diversification. Well, this fund contains more than 100 stocks, I don't remember exactly how many. More importantly, it only focuses on stocks that are involved in clean energy. So specifically wind turbine and solar energy companies, but also some other various ones. And what you see is, if you had invested somewhere around here, you would have actually experienced a loss for a very long time. Additionally, inflation needs to be deducted annually, which means that your loss is even greater. And of course, this fund is not completely free. It charges an annual fee of X%, and that will also be deducted. So, your 10,000 euros here at the beginning, even if the price is the same 10 years later, you will no longer have 10,000 euros, and that will be less. And just a side note, I already mentioned the course on ETF investing, in which we also have a session on analyzing ETFs. Well, an advanced investor can do that. Looking at different ETFs, at various theme ETFs, and I can think of something here. Hey, wait a minute, maybe this fund is interesting. What is the future demand? And are the stocks in this fund possibly undervalued on average? If so, then it is likely that you can achieve returns if you invest. You have the patience, and then you see that indeed macroeconomic conditions are changing. There is an energy shortage, so the demand for clean energy is only increasing. The investor was therefore correct in his analysis, and that same investor, because he has the knowledge, can think at such a peak. Maybe the hype has gone a bit too far. I will take another look at my ETF. I will analyze it again, and I come to the conclusion that on average these positions are overvalued. So the chance of upward potential is lower than the downward potential. In other words, the chance of return in the short term is lower than the chance of loss. So the advanced investor profits from this. This is just a brief sidestep, an example of how, if you are an advanced investor, you can achieve a higher return even with ETFs. Of course, all the attempts you make to achieve higher returns come with a bit more risk, as you might time it wrong, or your analysis could be incorrect. However, by investing in the ETF, you at least reduce the risk of individual stocks underperforming, because you are still buying an ETF. This is also why I personally advocate in my own strategy for working with many ETFs, so I invest in different types of stocks, especially in stocks that I want to hold for a very long time. I really mean for 20 years. But I also have quite a few thematic ETFs that I just find interesting. For example, in cloud computing, yes, instead of analyzing all those stocks, I just buy the whole bundle, the whole haystack. So there is a fund, and it contains about 80 or 100 different cloud companies, and I just ride along with the average growth of all those stocks. As long as that ETF is relevant, whether it's the sector of clean energy or cloud gaming or whatever it is, cloud computing, there may be others as well. As long as that remains relevant, there is a plausible chance for growth. And that growth can be even greater than if you buy a global ETF that includes all industries. So such industries, for example oil, can decline in the long term, or for example gold can either decline or rise in the long term. Those kinds of things. So there's a lot to say about diversification. For more information, it is best to take a look at the course on ETF investing. Another risk with ETFs is currency risk. This fund is purchased in dollars. Let's say at this moment the euro is equal to the dollar because we usually buy in euros. Suppose we buy that fund for 20 euros just for convenience, and then we have a value of $20. Only if the euro decreases in value compared to the dollar or vice versa can we make a profit or a loss. In the long term, that can suddenly have an impact, and of course you can hedge that risk. Now, importantly, an ETF is not a guarantee of profit, and therefore, when we invest in ETFs, we always want to create a portfolio, so an ETF portfolio. Combining that with buy the dip, but more on that later, for that ETF portfolio and how to manage it, I have already mentioned. You can see our ETF course. And in the nutshell, it always comes down to the magical trick of an investment portfolio. We want to create a lot of diversification across different types of assets. So that means an ETF in stocks, an ETF in bonds, perhaps an ETF in commodities, an ETF in real estate, and a proper combination of these at the right percentages. That is how you reduce risk, even during your retirement. You now know what an ETF is, what it means, and what the advantages and disadvantages are, as you aim for an average return through passive investing. On the other hand, you also know that there are definitely multiple risks involved, and particularly in the short term, there is always volatility. Now we will look at a number of examples of ETFs that may be suitable for retirement. And then there is actually a difference between bonds and stocks ETFs, but of course there are also other types. Now, when you look at those bond futures stocks, we often see a chart that actually shows what the average return is of different types of assets. Now, the inflation is not 2% in this case, but 3%, even higher. And this covers a time perspective from 1926 to 2006. This came just after the financial crisis, and then it went very well for a number of years. So that naturally has an impact on the return. However, you indeed see a significant difference between the return of, for example, treasury bills or government bonds versus the stocks, in this case, large cap and small cap stocks. Now, small cap stocks, these are very small stocks with a market value. And that is also one of the reasons why we do it. Market value and how larger a company is. The less risky it usually is, because it is large for a reason. We have likely achieved a competitive advantage in a market based on strategic positioning. We usually have a stable earning model, etc. It is interesting to see that the different assets also generate different types of returns over the very long term. In the short term, we see other factors, and of course, the higher the risk, the higher the short-term volatility of such an asset. We are talking about ETFs here, so basically you can attach ETF to these: small stocks ETF, large stocks ETF. So what is the difference? Well, a government bonds ETF is likely to achieve a lower return than a small cap stocks ETF. A small stocks ETF will not achieve 11.7%, or maybe it will, because it simply reaches the average, and such a government bonds ETF. And that is the only thing you can do. So also take this into account in our calculation tool, in our investment strategy, with our investment portfolio. We just want to have a mix, so there are different concerns. Only if you are going to invest out of passion, especially if you are retired. Then a small cap stock ETF can be a good option. This means that you face certain risks over a specific period. It shows relatively more volatility. If the market crashes, an ETF with bonds, for example, will drop by about 20%. But a small cap stock ETF may decline by as much as 50 or 60%, or perhaps even more. So that is the difference. The closer you get to retirement, the less risk you can take. On the other hand, if you have many years ahead of you, you can certainly take more risks, because you will be able to withstand that short-term volatility. In fact, you will buy more, and this way you will achieve an even higher return. To further diversify that risk, as we have already mentioned, we need to supplement our portfolio with other assets. So we also have commodity ETFs, REIT ETFs, and the fast food ETF. Nowadays, there are even crypto ETFs, and maybe in the future, there will be some other types of assets. You never know. Now, this picture is very important. What does this picture show? It goes from 1960 to 2020 in this case. And on the other axis, the left axis, we see the return per year. The blue peak here, or that peak below, actually represents the real state of a year. So around 1960, there was a year in which the S&P 500, which is an ETF with 500 different stocks in America, was actually the most well-known stock exchange in the world. The 500 does not necessarily include the largest companies, but they must meet certain criteria, such as profitability and the like. The S&P 500 ETF is a very well-known and popular investment instrument. And actually, when we talk about average returns, it usually refers to the historical results of this ETF, of this stock index. But here you also have an ETF for that, even multiple ones. And that S&P 500, just for convenience, the ETF, it performed very well for a number of years. So even 1 year plus 30%. Another year, is it around 10%? Then there is a small decrease of 2%, and afterwards there is another peak of 20%. But you also see that there are a number of very large declines, down to even minus 30%, and the financial crisis even down to minus 40, minus 50%. So, what is it about? It is about a sense of realism, taking into account a number of very good years with very high peaks. And then you actually end up above this red line. And this red line represents the average return over this entire time period. It is around 9 to 10%, including the reinvestment of your dividends. And this is everything we base our investment portfolios on. For future returns, this is the average return. So you only see in the short term, with those peaks, one time it's above, the other time it's below. And if you had just stepped in here, what is it, just before 2000, then you would have had very bad years, 3 years in a row. After that, it recovers a bit, and then you get the financial crisis. So in this time frame of 10 years, you would have had a much lower return, perhaps even a negative return. So the average return on which we base everything is over a very long time frame. Since 1920, 1930, or maybe even a little further back. And that is why the average is very important. But it is also necessary to consider how to translate that into the current situation and for the next 5 years. For example, if you have 20 years, or even better, 30 years, then you can rely much more on those averages. And then you also see that there can be a number of years in which you simply achieve, for example, consistently over 20%. So just for convenience, you have saved 100,000 euros in ETFs, in this case, the S&P 500 ETF, and you get a 20% return for 3 consecutive years. This means that after the first year, you have 120,000, after the second year, you have 144,000, and after the third year, you have just over 160,000. In other words, more than 60,000 euros in 3 years. So that goes really fast. Well, if it goes well for so many years, then there will probably be a significant dip at some point, and you can anticipate that. But there are periods when you can make a seriously high return, although there are also periods when you can really just incur a lot of loss. Now, when we talk about pension investing and ETFs suitable for pensions, there are a number of characteristics we need to pay attention to. The most important thing is diversification. We have already talked about it, about risk diversification. Just because a fund contains 1,000 stocks does not mean it offers more risk diversification than a fund that contains 500 stocks. What could the difference be? The 1,000 stocks could all be in the same sector in the same country. Meanwhile, that ETF with 500 different stocks has good diversification across many different types of sectors. From industries such as agriculture and aviation to technology, and that fund also has diversification across different countries, ideally even across different continents. So that provides much more risk diversification than a fund with 1,000 stocks. It has more positions, but it is more concentrated. So, diversification is a concept that is linked to risk diversification, but it means more than just having a lot of stocks or a lot of bonds in a fund. Another important characteristic is low volatility, and we cannot look into the future. However, if an ETF has existed for a longer time, for example 30-40 years, we can make a kind of cautious assumption about whether the volatility is high or low. And if it performs relatively stable, and we examine the strategy for the coming years in the near future, and it is in the same line, then we can cautiously assume that he will be able to perform approximately the same in the future. That is a serious pitfall, because history is absolutely no predictor of the future. But yes, you do need to base something on something. And usually, there is a clear difference to be seen between ETFs that have higher volatility versus those that have lower volatility, and this has a lot to do with diversification. High liquidity is desirable, which means we actually only want to select funds that are particularly popular and have a lot of money invested in them. This way, we can easily buy and sell. This is especially important if you want to exit at some point. And just to give an example, if you have 500,000, it would be nice to be able to cash out that 500,000 all at once. But if you have a very small fund with low liquidity, you can't just cash out that 500,000 easily. It could take you a long time to do so. So liquidity is important. Important is the level of dividend coupon payouts. We have seen coupon rates with bonds. With dividends, for example, there are specific ETFs that focus on dividends. Good dividend, high dividend, different types and sizes, and very importantly, finally, is a low expense ratio. Expense ratio refers to a management fee, management costs, the management expenses that a fund charges each year for managing the ETF. Take, for example, the S&P 500. It is just a stock index, just like the AEX, and you have different investment companies that have created an ETF around the S&P 500. So then you have an S&P 500 ETF, and it is issued, for example, by an iShares or SPDR. And so you have a few more. You have Vanguard, which is very important. These are investment companies that create such an ETF. They manage it, and one charges more than the other. Well, there is a difference. So, exactly the same ETF. It's perhaps a slightly different strategy. But the same ETF that likely varies in liquidity can also differ slightly in dividend, probably not by much. And it can vary in expense ratio. So yes, if you can buy a similar type that is essentially cheaper every year, meaning a lower expense ratio, then you will have a higher net return. Here are some examples of ETFs suitable for pensions. Later in the module, we will play with our investment portfolio. We will see various examples of combinations of ETFs. This is just for inspiration to encourage you to explore further and, of course, to conduct research. We do not mention these terms lightly. However, we also do not provide personal advice, so you must be able to analyze and determine for yourself whether this is relevant to you or not. However, we have briefly arranged the number of positions, and we will mention several different ETFs, and also demonstrate that there are indeed clear differences that you need to take into account. Now, a very large and well-known one, and definitely Vanguard. These are almost all Vanguards. Vanguard is the pioneer of ETFs, and therefore has many popular funds with high liquidity. A very large bond ETF is BNWD, and the ticker is actually the abbreviation by which you can find such a fund. So you type BNWD stock or BNWD price on the internet, and when you search for this ETF, you see the price chart. Then you go to Vanguard, and you can view various characteristics of that fund. In this case, there are more than 16,000 different bonds included. And in this case, yes, it says dividend here, but actually it is the coupon rate. The coupon rate is around 2.5%. You see a lot of different positions in it, so that price performs relatively calmly. For example, in 2022-2023, there was a unique situation where inflation rose and interest rates suddenly increased from very low levels in a very short time. Yes, if you see that such a fund is heavily impacted, because as I explained, the choice is bonds. Bonds are linked to interest rates. The higher the interest rate, the less attractive it is to invest in bonds, and vice versa. What is interesting about those Vanguard ETFs is that they contain a lot of positions. So, 16,000 different bonds, which is really a lot. In principle, just these purchases for bonds are already enough. And why? Because these positions are all spread out across the whole world. There is also a piece of world in here, total world even. This is an indication of their strategy. But you can also read that strategy on their website. There is also a fact sheet that you should always download to see what the top 10 positions are and such things. Interestingly, the expense ratio is very low. So 0.20% is a bit average. And we see those from Vanguard, they are all actually below 0.10%. So that is really very cheap. The lower the costs, the better. And this one provides a lot of diversification. So this is just an example of a bond ETF that is particularly suitable for, let's say, if you want to invest with a lower risk. Not without risk, as a short-term loss of 20% is still quite significant, but it is relatively lower risk compared to other investments. The same type of variant, but then not bond but stock. Like, this ETF is focused on the whole world and then on stocks. It contains more than 9,000 different stocks. The dividend is somewhat lower, with an annual dividend. In contrast, the price return is much higher. This bond ETF realizes almost no price return. Such a stock ETF can typically yield an average return of about 7% per year. On average, over a long term. So, that means there are also elements of capital return included. The expense ratio is very low. Those 9,000 positions are spread all over the world. In my opinion, 60% America, 40% other world, so another world. The divestment is an ETF, that's how you win it back. The only downside to these two is that, as far as I know, they are not available for purchase at DeGiro, but they are at Maxim or eToro. However, that may change in the future. A variant of the Vanguard Total World Stock ETF is the VTI, the Vanguard Total Stock Market ETF. The name doesn't say much, but what is the difference between these two? The positions. But there is a crucial difference. There are fewer positions, but all these 4,000 stocks included are very many, and they are all American publicly traded stocks. So in those 9,000 of the VT ETF, the tracker, there are also European stocks and Asian stocks included, while this one only has American stocks. So yes, if America performs really well, great, then the VTI will perform better. But there are times when America is perceived as being overvalued as a stock market, while developing countries are undervalued, on average. So, such an otherworld ETF or a foreign market ETF will perform better. The WT combines everything, and this one is focused solely on America, so that is an important difference in geography. While the number of positions still matters, whether you have 3,000 shares or 4,000, statistically speaking, it actually doesn't make much difference. It really makes a big difference whether it is just America or the whole world. Another example is the Vanguard All-World ETF, which is indeed well known at Giro. Therefore, it is familiar to many Dutch people, the VWRL. I personally advocate for the IWDA, but most people are familiar with VWRL. By the way, it does have lower dividend leakage, but this one contains 3,000 different stocks, so slightly fewer than that VTI. The only difference between these two is that those 3,000 stocks are spread all over the world. The expense ratio is just more expensive. The expense ratio does matter. Compared to VD, which is the Vengo Total World Stock, there are more positions in it, but only statistically speaking. 3,000, 9,000, it actually won't matter too much. The long term, that actually won't matter too much either, and the expense ratio, that does matter. Simply put, the lower the costs, the better. Only then do you need to look at where you can buy this. In this case, we could buy the Vanguard FTSE All-World UCITS ETF in the Giro Core Selection for a long time. The Core Selection means free purchases, so there are no transaction costs. However, you still have that expense ratio, as that is simply the management fee from the fund itself. Buying and selling on a broker or investment platform also costs money, and if they fall under the Core Selection, it is free. But as far as I know, that has also changed at times, and this time it has not been included for a while. So you should always pay attention to that. And for example, you can buy that VT at Maxim or eToro as far as I know. But the transaction cost there can be somewhat higher, especially if that VBR is already part of the Core Selection. So there are always different scenarios possible. If you have questions, feel free to ask them in the community and we can look into it together. Everyone has insights, so we can help each other with that. Earlier, I showed an example about small cap stocks, which achieved higher returns as an asset class over the long term. And here we see an example, the ICS World Small Cap ETF. This fund is entirely focused on small stocks, on small caps. It also has a lot of positions. That's a good point. You see an ETF. It's an ETF. The Vanguard FTSE All-World ETF, that is what it is called. Accumulated or distributed. Distributed means that they pay out the dividend. Then 1.5% is paid out annually. Accumulated means the process of accumulating. Then they automatically reinvest the dividend. The same is true for the IBDA. Then they automatically reinvest the dividend. You see that the expense ratio is higher, but it is a different type of class. When we analyze ETFs and we look at the Vanguard FTSE All-World ETF with 3,000 stocks, and we download the Thomas fact sheet, or we simply go to the website and check the strategy, then you can also see what kind of stocks these are. In this case, take that 3,000, and then you can see that, for example, 80% of that is in large cap stocks. If that is the case, and you combine such an all-world ETF with a lot of large cap stocks with a small cap stock, small cap ETF, then you are taking two different types of asset classes. And it is also a kind of diversification, but then across different types of assets. Well, regarding that again, I can understand that I might be going a bit too fast right now, but that's okay. Just ask your questions in the community and we will help each other out. Finally, and this will be the last point, I want to leave it at that for this session, is that there are also ETFs in real estate. And then two examples, well-known examples, are the Vanguard Real Estate ETF. So there are 175 different positions in it. Positions in a REIT, R-E-I-T, which stands for Real Estate Investment Trust. In other words, a laundry fund, but then listed on the stock exchange. In that ICS Global REIT, there are 300 of them. What a difference. You will also see this when you look it up, but this Vanguard, the VNQ, focuses solely on America. The ICS Global REIT ETF also has positions in laundry funds in Europe and Asia, providing much greater global diversification. So given the goal of supplemental pension investing, I believe the ICS Global REIT would make more sense. In principle, it should yield somewhat less return. It could, However, it should also carry somewhat less risk in the long term. In other words, slightly lower volatility, Dividend is a small difference, and the costs are also a small difference. But you can think about what you want to achieve with all of this. How much return do I want? Do I have 5 years or do I have 30 years? That is a crucial difference. Based on all these building blocks, which we also see reflected in our calculation tool, investors can assemble portfolios based on an average return that aligns with our goal and our risk profile. Hey, it's great that you're checking out Happy Investors. Thank you for that. If you go to our website, happyinvestors.nl, you'll find the free ebooks there. Don't forget to download your free resource like the ETF book, which explains exactly how you can invest in ETFs. Also, our free calculator tool for wealth calculation is highly sought after. You can find some other downloads here as well. Additionally, on our website, happyinvestors.nl, you will also find our demonstrably higher returns than the S&P 500 and the AEX. For example, our growth stocks are currently up by 125%. And that in just 1 year. We talked about different types of ETFs, the risks, and also some examples specifically related to pension investing. And I always use the internet to consult sources. Actually, usually when I read a lot of things and think, hey, this might be interesting, mutual fund or bond fund, then I look up that fund on the internet. I go to the publisher's website. I am looking for that fund. I check the characteristics such as diversification, the turnover rate, the top 10 stocks, and I always download the fact sheet to see what is included. Based on that, I come to assumptions or conclusions or another broker. I don't use Giro to look things up. And it really doesn't matter who you are with, right? Giro or Maxim. I happen to use Giro myself. That's how I started many years ago. I also currently have an account with eToro, and additionally with Maxim. Actually, mainly eToro because I just wanted to buy certain mutual funds that Giro does not offer, specifically not from Vanguard. But that is of course personal. It doesn't have to be that way. A broker usually offers options, and if you make the right selection, it can also be with Giro. It's just a matter of making choices. Now at Giro you can go to products and then to ETFs, trackers. What you will see is a long list. And that means that if the ARK fund declines, then you make a profit. So you are actually betting that the fund will go down. Well, I can explain another time why people bet that it will decline. And you also see Ethereum, Chainlink, Bitcoin, and implies if the ARK fund declines, you achieve returns. And implies if the ARK fund declines, you achieve returns. A bit of a loner, Bitcoin. They come up with the craziest things. And that's also the risk. It just keeps getting crazier. Yes, and everything is possible. You can also go long. The difference between short and the opposite of that is long. That means long term. Then you bet that the returns will go up in the long term. Well, here you see a selection of 100 and then times 60. So there are a lot of different ETFs. So you don't really get much out of this. What I usually do is, okay, I searched online and I just simply want to buy or sell that ETF. So I have actually gathered all my information from different sources outside of my investment platform. There usually isn't much interesting information there. We talked about that bond ETF, the Vanguard Total World Bond ETF. It contains more than 16,000 different bonds. We can only buy it through eToro, but not through Giro. Well, an example of one that is available through Giro is the VECP, which is the abbreviation, the ticker. And that stands for the Vanguard Euro Corporate Bond ETF. Corporate bonds. There are about 3,000 different corporate bonds, all located in Europe, the continent of Europe. And we can also buy this in the currency euro. It says so here. We can also buy it in, for example, pounds. But then you face a currency risk. We are Dutch. We buy in euros, so we actually choose a fund in euros when it is available, of course. This way, we have no currency risk. Here are different types of funds. It may be that this falls under the Giro core selection, and then in the core selection, you actually need to look up which exchange it is from. Because if you buy this, you may still incur transaction costs. Whereas if you buy this, for example from the Dutch stock exchange, you might not have any transaction costs. TDG is the German stock exchange and Milan is from the Italian stock exchange. So, for this case, we are choosing the Dutch stock market. I'm not sure if this falls under the core section, but it's just a quick example. Yes, what do you see here? Here, you actually don't get that much interesting information. You can look at the graph. Actually, what we see is that, as we have already said, it is a bond ETF. European companies are stable in Europe. What's the short-term risk? In this case, the graph goes from 2017 to 2023. We see here that the price was 55 and it plummets here to 45, so approximately minus 20%. It remains very stable for a long time, but then there are significant peaks and drops within just a period of a few years. So if you think you're going to enjoy a nice retirement and enjoy that pension, then at some point, bam, 2 years later, you're actually significantly in the red. Well, for whatever reason, you don't panic and just hold on tight. You're lying comfortably on the beach, and then bam, just as you're about to celebrate with your cocktail that you've recovered, there's another significant drop in the market, and here it lingers, staying a bit lower. Yes, this specific scenario is related to interest rate policy, which has risen very quickly in the short term, and the potential fear of depression and some other issues, I must say recession, but it just shows that not everything is without risk.